Okay, everybody, it's me, Gregory Mannarino. It is Tuesday, December 20th, 2022, people. Something kind of dramatic just happened, and I don't know if it's getting a lot of attention right now. However, this event is definitely rattling the global bond markets. Globally, bonds are selling off. So here's the story. The Bank of Japan is now allowing its 10-year yield to float. Okay, so this, to me, looking at why the Bank of Japan is doing this here, is going to inject more instability into the global debt markets, which is already on a knife's edge. You all know this here. The debt market is absolutely insolvent. It is unstable. Central banks have been doing a good job of trying to keep it stable, keeping that illusion real. Now, this move here by the Bank of Japan here, now allowing their 10-year yield to float around a little bit instead of being stuck at zero, as I just said, is spooking the debt market. Here in the United States, the 10-year yield is on the rise. The MMRI is higher. The U.S. dollar relative strength did come down a little bit. Now, we need to keep our eyes on this, and I promise to keep all of you on top of the situation here. Could this possibly cause a ripple effect where we're going to see a lot more instability in the debt market? You remember a couple of months ago, like 2 months ago, it was an incredible situation watching global bond yields sell off and getting bought up and sell off and bought up. It was rattling the stock market pretty hard too. So I'm not really sure, and I'm not saying this is, a major event here, but we need to see, by gauging what global bond yields are going to do after this decision from the Bank of Japan, what's the effect of it? Is it going to cause another uncontrolled rapid spiking in global bond yields, which will clearly hit global stock markets, or is it just going to be a non-event? You and I need to pay attention to that. I will keep you ahead of the curve as always on this. I watch this stuff like a hawk. You all know that here. I really don't care, honestly, what the stock market does in the short run. I mean, markets go up, markets go down. They're volatile, but it's the debt market that's the driver of all of this, and you know that. So with this occurrence here out of the Bank of Japan and seeing the effect of that, it's pretty profound right now globally. Well, let's just see how it plays out here. This is what I'm talking about. When you and I get in here and we discuss the market, how I always say it's a game of incomplete information. You try to fill in the gaps. I don't think many people, definitely not me, would have expected the Bank of Japan to do something like this. So now this throws a whole new set of dynamics into the situation. We need sincerely to focus a little more on what the effect is going to be here, and like I said, I'll keep all of you on top of that. Let's just go over the market real quick after that, so I could get my head on straight, and then I have a whole bunch of stuff to talk with you about. So, as I said, on the back of this, global bond yields rising, MMRI higher, U.S. dollar lower. Crude oil is catching a bid. Silver is higher by over 3% right now. Gold is catching a bid. Bitcoin is catching a bid. Cryptocurrencies are catching a bid. That's kind of the side effect of this action here with regard to this Bank of Japan move. Like I said, there's so many facets to this. And in my view, that's what makes this so interesting. So now we have another thing that we need to pay attention to. Look, several weeks ago, I was relatively certain that we were going to get a Santa Claus rally. The market was setting up that way. Absolutely. Risk in the market's rising now. We have a whole new dynamic with the Bank of Japan. Are we going to get a Santa rally? If we don't get it, if this doesn't start like today, just about, it's not looking too good. And there's a Wall Street adage. It goes something like this. Let me get my head on. If Santa Claus fails to show up on Wall Street, the bears come crawling in. So let's see how that plays out here. Like I said, this is interesting. This move by Japan, and what lies underneath that, obviously, is again, in my view, central banks really going out of their way to pressure people on a global scale, and it's not going to stop. I've explained this to the point of like ridiculousness, and the pressure on people is going to increase here. Their debt burdens are going to increase here exponentially, and the cost of living is going to continue to rise. Things are going to get much, much harder for members of the middle class, prior members of the middle class who are still trying to maintain that illusion here. And as I said, the rich and the well-off, they're sidestepping a lot of this stuff. I explained this yesterday. So the rich and the well-off here, they're kind of stepping out of the system by using the cash that they have put away. So they're not feeling the pinch of rising rates. I mean, like I said, big ticket items here, housing, automobiles, the stuff that the general population has to take out loans for. Well, the well-off and the rich don't have to do that. So they don't have to pay these ridiculous whatever is associated with the purchase of these things with regard to loans. So anyway, it's always the same story here. You hear the dog shit out of the mouth of the politicians, how they're making everything good for the middle class, and they really care about the middle class. It's all bullshit. They couldn't care less. All of these people, they're multimillionaires, all our politicians are for the most part. Even Bernie is a multimillionaire. Yeah, but he really wants to help the middle class. Look, it's all a snow job on a massive scale. And they know where this is all going. Every single one of them knows where this is going, the creation of this new two-tier society, how this is playing out, central banks running the entire show, which you're not allowed to know about. Anyway, so a couple of other things are going on here on top of the bond sell-off because of what the Bank of Japan is doing here. So let's talk a moment here. What do we understand Congress must do to keep the Ponzi scheme going? So it looks like a $2 trillion spending bill is going to be shoved down your throat. And where's that cash come from? Where does all that cash come from? Because we don't have it. The United States, in case you're new here or have never heard this before, is the largest debtor nation the world has ever seen. There's nothing that comes close to this. Okay. Although Japan's debt to GDP ratio is much, much higher, like 250%. We're over 110% here in the United States. We're going to turn it into Japan. It's just a matter of time. And central banks are going to make sure that does happen. But in order to keep the system going, our politicians need to create reasons out of thin air. I've told you this a million times, real or not, to just make sure cash is pulled into the now. Expanding wars, warp speed vaccines, all this stuff plays right into the hands, the bloody hands of central banks that are more than happy to lend. Do you understand? I think you do. So let us move forward. So this is an incredible situation here, people. So mortgage applications have fallen nearly 50% year over year. That part of that is the well-off and the rich here sidestepping the whole situation and buying with cash. But it also has a lot to do with people. People can't afford anything anymore. They're swiping those credit cards just to make ends meet. They're becoming slaves to the system, a nation of renters. So the quote-unquote American dream of owning a home, well, it is just a dream. It will remain that way for most people. It's unfortunate, but that's really the truth here. So another thing we found out, so central banks are stockpiling gold. In Q3 this year, central banks stockpiled over 400 tons of gold. But you remember, they only hold it for tradition. It's tradition. You remember that's what Bernanke said? It's unbelievable, people. You can't make this stuff up. So HSBC is expecting the U.S. dollar to weaken more than what we're already seeing. And what does that mean? Higher inflation. A weaker dollar, it takes more weaker dollars to buy anything, okay? So you can expect, as this guy has been explaining to you since time immemorial, inflation to get much, much worse. And this is interesting too. The real estate investment trusts have now suffered their worst year ever. Ever. And none of this stuff should surprise any of you. I really honestly believe I have kept you ahead of the curve. You can easily foresee what we have now because of what I've spoken about in the past and where we're going. What we're speaking about right now, everything that we're talking about is going to come true. And it may actually be a lot worse off than we even believe it will be, because central banks are determined to continue to crush the economy, crush an entire class of people. And this is a collective action here. They're working in concert together, central banks, to fulfill their absolute end game to become the lender and buyers of last resort. So they have a slave planet, an entire planet that is dependent 100% on what central banks are doing. That's what we have right now. Can't you see that? And our politicians here in the United States and around the world are going to continue to play the game. Let's continue to pull cash, trillions of it, into the now to allow central banks to continue to inflate as you and I pay the price for it, people. It really is almost like out of a science fiction movie, but it's reality. All right, look, as usual, I want to hear from you. I covered so much in this video blog. Let me know what you think about what the Bank of Japan just did and how it's hitting the global bond markets that are now selling off. We need to keep our eyes, I can't stress it enough. The bond market, as you know, is the key to all of this. If in fact we start to see an uncontrolled sell-off here in the debt market, which we had a while back, central banks stepped in and started buying more, trying to give the illusion of a stable debt market here. If that gets out of hand, well, it's over. It's literally over. And we have the best tool on the planet, at least in my opinion, to track this, the Mannarino Market Risk Indicator, which measures risk in the debt market and allows us to gain a perspective as to where the global stock markets are going to go, even the economy. I mean, the higher the MMRI goes, the worse off the economy is going to be. You understand? It should be pretty obvious. Anyway, so I hope you utilize that tool. Free to you, free to everybody. Link in the description of this video. All right, that's it, people. This guy here loves you a lot. I mean that from the heart. Please comment. Please share the video. If you got anything out of it, thumbs up. There's a little button down here. Would really make this guy happy. I will see all of you at the end of the day. We'll sum this all up.